Be Wealthy and Smart, episode 1638.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about why the Fed kept interest rates unchanged and what that means for consumers. So today was the Fed meeting, and the Federal Reserve did not lower interest rates, which was the anticipated response. But there was a lot of new economic data that came in that is behind that decision. Earlier today, the Producer Price Index, which tracks the change in wholesale prices, rose 0.7% in February, which was well above the 0.3% that economists polled by Dow Jones had estimated. The report shows that inflation was already in a precarious spot prior to the Iran war breaking out, an event that has heightened stagflation fears amid rising oil prices. Todd Schoenberger, CIO at Crosscheck Management, said the hotter-than-expected number is specific to tariffs. This is structural inflation, not temporary, and is likely going to impact monetary policy deep into the third quarter. He said, add in the hotter energy prices we've been seeing since the Iran war began, which have yet to show up in these reports, and Wall Street is bracing for rapidly rising prices that will clearly flow down to the consumer level. Oil futures today have been hovering around $96 a barrel. So after that news of the Producer Price Index came out, the Federal Reserve voted to hold its key interest rate steady as policymakers navigate their way through higher-than-expected inflation readings, mixed signs on the labor market, and a war. The vote at the Fed was 11-1 to keep the benchmark federal funds rate unchanged. However, the chairman has said he continues to believe there will be 1 to 2 interest rate cuts this year. How this impacts consumers is the benchmark 10-year Treasury yield is the barometer for mortgage rates and other long-term loans, and that was boosted to 4.208%. Short-term rates are more closely pegged to the prime rate, which is typically 3 percentage points above the federal funds rate. And things like credit cards, which have a short-term variable rate, are closely pegged to the Fed's benchmark. The average annual percentage rate has held just under 20% since November, according to Bankrate. Matt Schultz, chief credit analyst at LendingTree, said credit card rates don't tend to move much unless forced by the Fed, so I expect that we may see a few months of relative stability. Also, fixed mortgage rates don't directly track the Fed. They are largely tied to Treasury yields and the U.S. economy. Concerns that the expanding war in the Middle East may fuel inflationary pressures have already pushed the average rate for the 30-year fixed-rate mortgage up to 6.29% as of Tuesday from 5.99% at the end of February, according to Mortgage News Daily. Federal student loans are also fixed and based in part on the 10-year Treasury note, and current interest rates on undergraduate federal student loans made through June 30th are 6.39%, according to the U.S. Department of Education. Car loans reached an all-time high of $43,759 at the end of last year, according to Edmunds, and the average monthly payment on a new vehicle purchase is at a record high, as is the share of new car buyers with an auto payment of $1,000 or more. One potential bright spot for car shoppers is eligible taxpayers can deduct up to $10,000 in auto loan interest this tax season under a temporary provision enacted by the administration's One Big Beautiful Bill Act signed in July. And of course, interest rates also impact savings rates. The yields tend to be correlated with changes in the target federal funds rate. So although no rates on certificates of deposit and high-yield savings accounts have fallen from recent highs, they are still holding above the annual rate of inflation. And the Fed has no direct influence on deposit rates. So in summary, the Federal Reserve kept interest rates unchanged at its March meeting. Its benchmark has a knock-on effect on many of the borrowing and savings rates Americans see every day, but the Fed is still looking for 1 to 2 interest rate cuts this year. So we'll continue to follow the story and report back to you as it unfolds. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my podcasts are on my website at lindapjones.com/podcasts. And while you're there, sign up for my weekly newsletter for more wealth tips for your financial freedom. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.